Years of cheap monetary policy reshaped the US economy, fueling debt, speculation, and fragile growth. As interest rates rise, the illusion of easy expansion dissipates. The interest rate trap exposes an economy dependent on low borrowing costs, where households, businesses, and the government are now facing difficult adjustments, slower growth, and a higher risk of instability. Let's look at our analysis below. The camera opens on a high-speed time-lapse of a glowing metropolis, a shimmering monument to the era of effortless expansion. For over a decade, the global economy has hummed to the tune of near-zero interest rates, a period of easy money that felt less like a policy and more like a permanent law of nature. We begin with the seductive glow of the credit cycle. In this environment, debt was not a burden, it was a tool, a lever used by corporations to buy back shares and by individuals to chase the soaring valuations of the suburban dream. But beneath the surface of this prosperity, a predator was growing. We call it the interest trap. It is the moment when the central bank, forced by the rising tide of inflation, begins to tighten the taps and the cheap liquidity that fueled the world starts to evaporate. As the cost of borrowing climbs, the vast architecture of debt, from student loans to sovereign bonds, begins to groan under its own weight. We are entering a season of reckoning, where the illusions of the past decade are stripped away, revealing a harsh reality. When the cheap money runs dry, the foundations we thought were solid are often nothing more than sand. The golden age of borrowing is over, and the bill has finally come due. The signs of the trap closing are first felt at the periphery of the financial system. It begins with a sudden, unexplained volatility in the bond markets and a widening of credit default swaps, CDS, for corporations that once seemed invincible. We see it in the interest coverage ratio of small businesses, the terrifying moment when the cost of servicing a loan exceeds the profit generated by the business itself. In the residential sector, the signs are found in the mortgage lock-in effect, where homeowners with low-rate legacy loans are trapped in their houses, unable to move as current rates double or triple, causing real estate inventory to vanish and market liquidity to freeze. Economic indicators start to diverge. While employment may look resilient, the delinquency rates on credit cards and auto loans begin a steady upward climb. These are the tremors of a systemic shift. The era of the zombie company firms that only survived because they could roll over debt at 0% is ending. As the tide of cheap money recedes, it reveals who has been swimming naked, exposing a landscape of hidden leverage and fragile balance sheets that can no longer withstand the gravity of positive real interest rates. The mechanism of the shock is a brutal deleveraging cycle. When the central bank raises rates, the value of all existing debt-based assets falls. This is the duration risk that sits at the heart of the modern portfolio. As the discount rate rises, the present value of future cash flows shrinks, leading to a massive repricing of stocks, especially in the tech sector where growth is projected far into the future. This creates a margin call on a global scale. Investors, faced with falling asset values, are forced to liquidate positions to raise cash, which in turn drives prices even lower. A classic deflationary spiral in asset prices, even as consumer prices remain high. The mechanism is further complicated by exchange rate volatility. As the US dollar strengthens due to higher rates, emerging markets that borrowed in dollars find their debt burdens exploding in local currency terms. This is the dollar milkshake theory in action. The US sucks up global liquidity to service its own debt, leaving the rest of the world parched. This mechanical tightening is indiscriminate, hitting the real economy through higher borrowing costs for everything from tractors to factory equipment, effectively stalling the engine of production in favor of debt servicing. Global case studies highlight the lethal nature of the interest trap. In the 1997 IMF crisis, many Southeast Asian tigers were caught with massive short-term dollar debt when rates shifted, leading to a total collapse of their banking sectors. Today, Turkey provides a modern laboratory for what happens when a nation tries to defy the laws of interest, leading to hyperinflation and a decimated exchange rate. In Greece, We saw the debt trap play out at a sovereign level, where high interest on legacy debt meant the nation had to run permanent surpluses just to stay in place, leading to a lost decade for its youth. Argentina serves as a recurring warning, a country that becomes addicted to foreign credit and then finds the taps closed when global risk appetite changes. Even the yen-carry trade from Japan shows how the search for cheap money can distort global markets. When that trade unwinds because interest rates finally rise, the shockwaves are felt from London to New York. These cases prove that liquidity is a fickle friend. It arrives as a gentle rain, but leaves as a devastating drought, leaving behind a landscape of austerity and social unrest as the population is forced to pay for the free lunch of the previous decade. Within the United States, the interest trap is a generational pincer. For 30 years, the US economy has relied on falling rates to drive consumption. Now, with the trend reversed, the impact on the American working class is profound. We see it in the wealth gap, which was widened by the asset inflation of the cheap money era, now hardening into a permanent class divide. The real estate market, once the primary vehicle for middle-class wealth, has become a fortress protected by high entry costs. For a person living through this, the impact is the squeeze. Your rent goes up because your landlord's financing costs increased. Your car payment rises, and your disposable income vanishes. The US. Government itself is caught in the trap as interest payments on the national debt surpass the defense budget. Fiscal space for infrastructure or social programs disappears. This is the hollow economy at its limit, a system where the majority of new credit is used not to build new factories, but to pay interest on old debt. The liquidity that once felt like a rising tide lifting all boats is now revealed to have been a flood that merely lifted the houses off their foundations, leaving the inhabitants to drift in a sea of insolvency. The responses from governments and central banks have become increasingly desperate as they realize the magnitude of the trap. Initially, they attempt forward guidance, trying to talk the markets into stability. When that fails, they resort to quantitative tightening, trying to suck liquidity out of the system without causing a total crash, a feat of macroeconomic surgery that has rarely succeeded. We see central banks caught in a dual mandate nightmare. They must raise rates to kill inflation, but doing so threatens to trigger a sovereign debt crisis. To avoid this, some governments may turn to financial repression, capping interest rates below inflation to slowly erode the real value of their debt, effectively taxing the saver to bail out the debtor. This leads to a loss of trust in the currency and a spike in CDS spreads as investors realize the game is rigged. The institutional response is often a series of emergency facilities that provide temporary liquidity to banks, but these are merely band-aids on a structural wound. The reality is that the central bank can print money, but it cannot print value. And the attempt to do so only delays the inevitable cleansing of the credit markets that must occur for a true recovery to begin. Personal survival in the interest trap requires a complete psychological pivot. The rules of the last decade, borrowing to the hilt and chasing growth, are now liabilities. The new strategy is solvency and liquidity. For the individual, this means prioritizing the elimination of variable rate debt at all costs. In a world where cheap money is gone, cash is king once again, but only if that cash is held in productive assets or short-term instruments that benefit from higher rates. The personal survival strategy involves downsizing expectations and focusing on yield over speculation. Useful insight for the viewer: look at your burn rate. In an interest trap, the cost of living is driven by the cost of money. By reducing your dependence on the credit system, whether through self-sufficiency, strategic saving, or barter networks, you reclaim your autonomy. You must become your own central bank, maintaining a reserve that allows you to act when others are forced to react. True security is no longer found in the market value of your home or your 401, but in the reliability of your income and the low leverage of your lifestyle. In the era of the trap, the winner is the one who owes the least to a system that can no longer afford to be generous. The remarkable closing message of this documentary is that the interest trap is a necessary, albeit painful, return to economic reality. For too long, we lived in a hall of mirrors where the price of money was distorted, leading to a world of malinvestment and artificial wealth. The end of cheap money is the beginning of consequence. It is a call to return to an economy based on productivity, innovation, and true value rather than financial engineering. While the transition is fraught with volatility, it also clears away the soup deadwood of the zombie era, making room for a new generation of businesses that can actually stand on their own 2 feet. The lesson for the viewer is that resilience is built in the lean years, not the fat ones. We are rediscovering the value of a dollar and the importance of sustainability in our personal and national finances. The ghost of the easy money era is fading, and while the debt remains, so does our capacity to rebuild on a more honest foundation. The interest trap is not a dead end, it is a turning point. As the sun sets on the age of credit, it rises on an age of accountability, where the true winners will be those who value work over wealth and reality over rent. The trap has closed, but the path to a genuine, grounded prosperity is finally open. As the lens shifts to the social landscape, we see the interest trap creating a great reevaluation of our priorities. For 30 years, we were told that growth was the only metric that mattered, fueled by an endless supply of liquidity. Now, as the debt becomes a weight, we see a return to community and localism. The impact on a person's life is the shift from consumer to steward. We see it in the rise of repair, cafes, tool libraries, and a minimalist aesthetic that prizes quality over quantity. This is the cultural hedge against the interest trap. When the global markets become too volatile and the cost of money too high, people turn inward to their social capital. The insight for the viewer is that wealth is a multidimensional concept. It is your health, your skills, and your relationships. In a world where the financial architecture is crumbling, these are the assets that cannot be foreclosed upon. The interest trap is forcing us to ask, what is a good life if it isn't built on a foundation of debt? The answer is found in the resilience of the human spirit and the creativity of those who refuse to be defined by their balance sheet. We conclude our journey through the interest trap with a vision of a restored balance. The era of cheap money was an anomaly, a blip in the long history of human commerce. Its end is the homecoming of the global economy to the first principles of profit and loss. The architecture of collapse we feared is actually the deconstruction of an unsustainable cascade. The remarkable message is that prosperity is not a gift from a central bank. It is the harvest of labor and intelligence. We have the opportunity to build a financial system that is transparent, decentralized, and anti-fragile. The signs of crisis were the alarm clock, waking us from a debt-induced dream. Your role in this new era is to be clear-eyed and proactive. By understanding the mechanisms of the trap, you have already begun to escape it. The money may have run dry, but opportunity is a well that never fails for those who know where to dig. As the final credits roll, remember, the value of your life is not determined by the interest rate of the day, but by the integrity of your choices. The trap is only for those who refuse to see the truth. For the rest of us, it is the threshold to a future built to last.